Hey guys, welcome to the chapter that's going to cover variable costing. We're going to expand a little bit more on what we learned in the previous chapter, so it's very essential that you're familiar with what fixed cost, mixed cost, and variable cost are before we begin work here. So if you're not sure, go back and view the video I made for the previous chapter. Basically, what we're going to see here, this is going to be one of those first chapters where we really learn about some of the shortcomings for using absorption costing, which by the way is required for external reporting, both for income tax and for GAAP purposes. And it's very good at what it's intended to do, which is to be used by external users. But for internal users looking to make decisions on maybe which products to build more of or which products to cut back on, it has a lot of shortcomings. And so variable costing we're going to see is really effective, and it's going to paint a more realistic picture as to what we might expect that would happen because we're able to split the cost between being fixed costs and variable costs. So as we mentioned before, absorption costing is what we would have used when we were performing job order and process costing, some of the first chapters that we spent a little time looking at. And those are going to treat all manufacturing cost as product cost. So that would include direct materials, direct labor, fixed and variable overhead. Okay, so we call it absorption costing because it absorbs all of those costs and treats them as product costs. And so remember, with a product cost, we're going to place that thing on the balance sheet and it's going to stay there as an asset until we eventually sell it. It might be 1, 2, 3, 4, who knows how long it might be before we actually sell it, and only once we sell it can we expense it as part of cost of goods sold. For in the meantime, until it sells, it's treated as an asset, and this is what we've seen before in the previous course that you took as well. In Principles of Financial Accounting, we were working with absorption costing then. So in last chapter, we became familiar with what a contribution margin was, and it's basically just the difference between our sales and our variable costs. And variable costing, as we see here, is gonna work. It's gonna really facilitate the process of using the contribution margin formatting that we're going to talk about and preparing those cost, volume, profit analysis charts that we had used in the last chapter as well. Okay, so the main difference we see here is that under variable costing, direct materials, direct labor, and variable overhead are treated as product cost, and fixed overhead is treated as a period cost. So this is the main difference. It's all about this fixed manufacturing overhead. Under absorption costing, we treat that as a product cost, which means we place it on the balance sheet until, who knows how long it will be, until those products are actually sold, and then they are expensed. And under variable costing, we expense all of that each period as though it's a period cost, okay? So remember, selling, general, and administrative expenses, those were the first ones that we were exposed to that we referred to as being period cost. And that means we're going to expense them in the period that we incurred them, and we are not going to capitalize those or treat those as inventoriable costs, meaning we're not going to put it on the balance sheet first. Okay, so it's fixed manufacturing overhead. That's going to be the key difference between these two different methods. So take a look here if you want, and this is just this exhibit here just kind of shows it in a presented a little bit differently. But we can see here that these three pink ones are considered product cost under both methods, and this manufacturing overhead is under absorption costing and is not over here under variable costing. But we do see that variable selling and administrative expenses are treated as being a period expense, and so are our fixed selling and admin expenses as well. Feel free to pause the screen here if you'd like. You might want to pause the screen here as well. So let's work a problem here together now. In this case, we are told to assume that 15,000 units are manufactured and our selling price is going to be $50 each. You can see down here that we're going to sell the same amount as we're going to produce. And we're going to see that as long as we sell the exact units that we produce, both absorption and variable costing are going to give us the same figure for net operating income. And you can think of net operating income as basically what it is it's our net income, but without factoring in things like maybe the rent income from unrelated piece of rental property that we have and interest expense and things like that. So we're going to see that there will be the same net operating income under both absorption and variable costing if the number that we produce is the same as the number that we're selling. And that's going to be the case here in this circumstance. And we're going to see it be a little differently here in the next problem that we work together. Okay, so once again we have our unit cost. Our variable component is $25. The fixed component here is $10. Okay, and let's take a look down here. Variable is $5 and fixed is, well, they don't tell us here, so we can figure it out if we need to. We can simply divide the total cost by the total number of units. So based on this information, we can see here that our sales, and by the way, the sales are going to be the same under either method, variable or absorption costing, are $750,000 bucks. And we came up with that number by multiplying the number of units times the sales price. Cost of goods sold in this case is going to be $525,000 bucks. We sold 15,000 units, and if we go back here, we can see that $35 was the unit cost. And that includes both variable and fixed components, right? Because under absorption costing, we absorb everything. Our gross profit is always going to be the difference between our sales and cost of goods sold there, so $225,000. Our selling and administrative expenses are $125,000. We can see that right here. It's these two added together. And so the difference between $225,000 of our gross profit and $125,000 of selling and administrative expenses leaves us with $100,000 bucks. Now it's going to be a little different when we prepare this under absorption costing, and notice our net income down here is also $100,000, isn't it? And that's because because the amount of units produced was the same as the amount sold. So our sales is going to be the same thing here. We still sold 15,000 units at $50 a piece. Our variable cost of goods sold, we sold 15,000 units, didn't we? But 25 is the amount we're going to use here for the unit cost, because we're not going to include this amount of fixed manufacturing overhead in the problem, are we? I'm sorry, we're not going to include it as part of the unit cost. We're going to account for it, but it's going to be down here at the bottom right here. See this 150,000? We're going to expense all of this in its entirety right now. We're not going to treat it as being an inventoriable cost. So the difference between our sales and our variable cost of goods sold is our manufacturing margin. Then we are going to subtract out the 15,000 units times the variable selling and admin expense, which is 75,000. And you remember from last chapter, we take our sales minus our total variable cost, and that's going to give us our contribution margin. And from the contribution margin, we know that in the pursuit of coming up with income from operations, we have to subtract out our fixed costs. Here's this right here, the fixed manufacturing overhead of $150,000, and here's the other fixed cost of $50,000 there. So once we subtract that out, we're also left with $100,000 bucks. So let's take a look at this exhibit really quickly, because we're going to see most of the time in reality the exact number to produce, it's not going to end up being exactly what we sold. I mean, how often does that happen that somebody that manufactures toothpaste or something like that sells the exact amount? You know, not all that common. So anyways, let's take a look here, and we can see that when we have production that is greater than sales, that absorption net income is going to be larger than variable income. So in this case, we are building our inventory, right? If we're making more than we sell, that means we're creating a stockpile, aren't we? We're building up our inventory. And when production is less than sales, that means we're using up some of that inventory that we built up previously. And so variable net income is going to be bigger than absorption operating income. And if production equals sales, this is what we just saw a second ago. Our absorption operating income and variable operating income are going to be the same. And if we produce and use and sell the exact same amount, we're not going to have a change in our inventory, are we? So here we're going to see an example of when our income from operation, of what our income from operations is going to be when the units manufactured exceed the units sold. So we're making more than we sell. We're building up our inventory. And we remember from that previous exhibit that we just checked out that means absorption net income is going to be larger than variable net income. So in this example, we're going to assume that we made 15,000 units and only sold 12,000. We're going to see in a second here that $40,000 is going to be our variable costing income, while $70,000 is going to be what we're going to have in terms of our absorption operating income. So under both of these, we only sold, with this example and the variable example we're going to work in just a second, we only sold 12,000 units. So 12,000 units at $50 a piece, that means we're going to have $600,000 of income here. Our cost of goods sold, remember, it's the difference between how much we had available to us and how much we had left as ending inventory. We had 0 for our beginning inventory here. So if we made 15,000 and we have 3,000 left, that means that 12,000 was the amount sold, wasn't it? And remember, our unit cost is 35 bucks a piece because we're including that $10 of manufacturing overhead. And when we look at variable costing in a second, we're going to see that it's only going to be $25 for our product cost in that example. Okay, so our ending inventory, like I said, we're going to subtract out. That leaves us with cost of goods sold of $420,000. Excuse me. This is also equal to 12,000 times 35. Okay, 420,000 is the cost we're assigning to those units that we sold. So the difference between those two is going to be our gross profit between sales and cost of goods sold. And of course, we're going to subtract out these period expenses, these selling and administrative, both the fixed component and the variable component here. Remember, we sold 12,000 units, and the variable selling and admin expense per unit was $5. And that leaves us with $70,000 of net income, or of operating income, income from operations. Okay, so we've double underlined that here. And like we said, we know absorption net income is going to be more. And so when we take a look at variable here in a second, we're going to see it's dropped all the way down to 40,000. So, as I mentioned before, our sales is going to be the same under variable or absorption. 12,000 units times $50. Remember, the next thing, we take our sales and we subtract out our variable expenses, don't we? So let's go through and do that. So we have our variable cost of goods manufactured. Now look, the difference here is that we're using 25 instead of 35 because there was that $10 of fixed manufacturing expenses, or I'm sorry, fixed manufacturing costs that we're going to exclude. So 15 times 25 gives us 375. 3,000 is what we have left times 25 gives us 75. So the amount that we had available to us minus the amount that we have left means it's the amount that we sold, right? If you take 12,000 and multiply it by 25, you'll get 300,000 as well. So the difference between those, instead of our gross profit, we call this the manufacturing margin. From that, we're going to subtract out any variable selling and administrative expenses. Remember, those were $5, and 12,000 was the amount of units sold. Okay, don't get that confused with the 15,000. That's the amount that we produced, and this is the amount that we sold. So we build up our inventory by 3,000 units, right? So anyways, 12,000 times 5 gives us $60,000 there. So our sales minus all of these variable costs is going to leave us with a contribution margin of 240,000 bucks. Our fixed cost here are going to be $150,000 of fixed manufacturing overhead, and our fixed selling and administrative expenses are going to be 50,000 bucks. So we're left with only $40,000 of net income here. So it went from 70 down to 40,000. So there's a $30,000 difference. And we're going to see here in a second, we built our inventory up by 3,000 units, didn't we? So 3,000 times the difference between 35 units, which is what we $35 per unit for our product costs that we used under absorption costing, and the 25 that we use here is going to give us that 30,000 bucks. And because we built our inventory, we know that absorption costing is going to be greater. And basically the reason for that is that it sent that portion of those manufacturing costs to stay on the balance sheet as an inventory item, right? So it's not going to be expensed right away. And a couple periods might go by before it's actually released. So let's take a look at this one. We can see there's that $30,000 difference between 70 and 40,000. Like I said before, there's a $3,000 unit buildup of our inventory. We increased it by 3,000 units, and the fixed cost per unit difference is this $10 here, right? Because remember, if we were to go back up here, we can see that we have $10 right here. This is the difference times the number of units that we build up in our inventory. Just want to take a second to point something else out, and that is the fact that under absorption costing, if we had two scenarios that are exactly the same, the only thing being different is that in one of these we're producing more than we're selling, we can see that we can boost net income. And we do that by keeping some of those costs that would have been expensed right away, where the more we build, the more of that we're able to stick in inventory. So we're able to see here that under absorption costing, it's possible to raise our net income by simply just stockpiling, building and building and building more and more inventory. And I mean, that's just a very easy way for somebody to manipulate the financial statements of a company. If we take a look at this slide here really quickly, I know that it's very busy with a lot of stuff going on, but like I said, let me kind of explain it to you here. Everything is exactly the same in here except for in this circumstance, this scenario, we're building 20,000 units, which is the amount that we're selling. Here we're building an extra 5,000 over that 20,000 that we sold, and here we stockpiled we increased our inventory by another 10,000 bucks. And we see under variable costing that our net income is going to be the same under any level. So this is kind of a more pure figure. This is kind of a more pure figure, isn't it? Because we're not able to manipulate our net income or our income from operations just by simply building up and building up and building up more inventory. This kind of summarizes what we were discussing a second ago. So we've discussed some of the shortcomings of absorption costing, so why would anybody want to use it? You can see here there's several reasons why. Please let me know if you have any questions, and have a nice week.